So what is a non-QM loan? A non-QM loan stands for a non-qualified mortgage. And so after the crash, pretty much all of the alternate products called subprime or non-conforming at the time pretty much just evaporated. And everything that was being done was either a government loan, FHA, VA, USDA, or your typical conventional loan, which is Fannie Mae and Freddie Mac. And those loans are great, but there is a market that does tend to be underserved. And that market is for folks who can't traditionally prove their income. After the crash, the CFPB, Consumer Financial Protection Bureau, came up with what they called a qualified mortgage. And a qualified mortgage had to meet certain rules, such as the lender has to show your ability to repay the loan. It can't contain any risky features like, say, a 40-year term or a balloon payment, uh, interest-only features, or a negative amortization type product. It's got to be a vanilla loan. There are limits on to how much income can go towards your debt, otherwise known as DTI or debt to income ratio, meaning you can only spend a certain percentage of your income on all of your debts combined, and the lender has to assure that you stay within those parameters. QM mortgage, qualified mortgage, also does not allow excess points and fees. It's got to be reasonably priced. So what does the lender get for that? Well, they get certain legal protections. Now you can still sue, just makes it a little bit harder because the lender's done their due diligence in giving you a mortgage. So what's a non-QM? Well, obviously, it doesn't have to meet those parameters. Typical non-QM loan nowadays will use alternative means of verifying your income, such as looking at your banking statements, whether that be business or personal. They'll take a look and see what kind of cash flow is going through your accounts and maybe qualify you on that. They may look at just a profit and loss statement, take the word from your CPA that, yeah, this is what that person makes. They may only look at your 1099 statement and not look any further than that, such as tax returns to see what kind of deductions you had. Only concern there would be, their only concern there would be looking at the total amount of income on your 1099. There's a unique product called the DSCR loan, debt service coverage ratio. And what that is when you use just the income generated off of an investment property to qualify. So if you're making enough rental income that it covers the mortgage payment on that specific property, they have no desire to look at any other income from you. So some pretty interesting times where some pretty interesting products are coming to market. If you think one of those might work for you, reach out for more detail.